So today I'm going to be talking to you about class level 1B, narrow range formations and triangle formations. Yeah. Now these are very important formations. These are trading concepts. These are not charting concepts, which means that you can actually trade and make money out of them, and hence they're very important. They actually give you a trade, and they actually tell you what is to be done and what not to be done in the market. So narrow range formations and triangles. NRF stands for narrow range formations. Yeah, it's a trading concept, not a charting concept like I explained to you before. Yeah. So what is a narrow range formation? Narrow range formation is a formation where the price starts moving in a narrow range. And the reason why it remains in a narrow range is because the demand and the supply remain constant at that point of time. And we all know in the stock market, the demand and the supply can never remain constant. Yes, so whenever there is a demand and supply remaining constant in the market, yeah, the prices are expected to move either up or either down. So what is a narrow range formation? Narrow range formation is a formation where the price starts actually moving sideways. So if you look at it, here the price has started going up, and while the price was going up, somewhere down the line, the price started moving sideways over here. If I have to show you the same thing in candlestick patterns, we are looking at price start going up. So the prices are going up, and as prices start going up, the prices have started moving sideways. And when the prices have started moving sideways, it means that the demand and the supply at that point of time is constant. Yeah, look at this. If you can actually draw two lines which cover up the sideways formation, and the price is actually moving between these two lines, which means that there is a demand and supply. The bulls and the bears have equal pressure in the market, and whenever bulls and bears have equal pressure in the market, the price starts moving sideways. Yeah. So this is what is called as a NRF, narrow range formation. This is also an NRF, narrow range formation. This is in line chart. This is in candlestick chart. Demand and supply remains constant, and it happens only for a small period of time. It doesn't happen for a longer period. It only happens for a smaller period of time. Now we can take advantage of this and actually end up making money out of this. So let us deconstruct how a narrow range formation happens. Consider that the price is going up, and as the price is going up, the price was going up because there was a huge demand, and suddenly you realize that the demand and supply is being constant, and while the demand and supply is being constant, the price starts moving sideways. And as the price starts moving sideways, we actually see that there is a lot of demand over here. So this is where the demand exists. But if you also notice, then there is a lot of supply which also exists here. So there is a demand here and there is a supply here, and because the demand and supply is constant, the price is moving sideways. And when the price is moving sideways, what it basically means is that the buyers and the sellers are getting more and more eager, because there are people who are buying into the market because they feel that the price is going up, but there are also people who feel that the price should be going down because there might be some news. So there are people who are eager to buy, and there are people who are eager to sell. Now between the two of them, when they are battling, and this is what is called as a classic battle of the bulls and the bears. And when this happens, either the bull is going to win or the bear is going to win, and we will see what and how. So the moment this happens, either the demand starts exceeding supply at one point of time, or supply starts exceeding demand at one point of time, and because of that, either the price goes up like a rocket or goes down like a stone. So again, prices are going up, prices start moving sideways because the demand and the supply is constant, and as the demand and supply is constant, the bulls and the bears, the buyers and the sellers, are getting more and more eager because they want the price to move in a certain direction, because they believe that the price will move up or down. And out of these two, either the supply gets exhausted or the demand gets exhausted. And if the demand gets exhausted, then the price goes down, and as the price goes down like a stone. Or if the price goes up, it goes up like a rocket. This is what is called as a NRF. So very quickly, let me show you different types of narrow range formations which occur in the market. Yeah, the first is what is called as a wide narrow range formation. Prices are going up, and then the price starts oscillating between a wider gap. There is a lot of supply on the top, and there is a lot of demand on the bottom. Yeah, so the bulls are getting eager here and are buying because they feel the price will go up, and the bears are selling here because they feel that the prices are going down. And this is a second type narrow range formation. It is called as a narrow range formation, and in this prices are going up, but the prices start moving in a very thin manner. Yeah, they are actually spread out, and the bulls and the bears, the lines where the bulls are buying and the bears are selling, is very close by, and because of this is very close by, it is called as a narrow range formation. So this is a wide narrow range formation, this is a narrow range formation. Yeah, so how do you trade this formation? It's a very easy formation to trade. What you need to do really is, so as the price starts breaking above this, what you need to do is you need to end up buying here, or you need to end up shorting at this point. There's a technique which is called as touch if buy, touch if sell. So it's a trading concept. Yeah, again, if you are in a narrow range formation, you go long here and you go short, and voila, this is how you make money in narrow range formation. So now we are going to talk about a triangle formation. Triangle formation is also a trading concept. You can actually trade it and make a lot of money out of it. I definitely use it as a major strategy of mine to make money out of the market. Yeah, so let's understand what the triangle formation is. Yeah. So what is a triangle formation? Triangle formation is a formation where the price starts moving up or it starts moving down. Let's consider that the price is moving up at this point of time, and then price kind of consolidates. Yeah, now if you had to see the same diagram in candlestick formation, this is how you would see it. Yeah, this prices have started moving up, and as prices moving up, it's kind of bouncing up and down, and as it is bouncing up and down, it is kind of bouncing in a very narrow range formation. Yeah, and if you actually draw the lines like this, you can see that this is a triangle formation. Yeah, if you draw lines here again, you can actually see that the prices are moving in a triangle formation. This is a triangle formation, and you can actually make a lot of money out of it. So understanding triangle formations in a better manner, first of all, let's draw a chart. This is a chart. So this is where the price is, this is where the time is, price and time, simple chart. Yeah, and let's look at some candlestick formations on it. Here the prices, these are green candles, and the prices are going up, and then suddenly it comes down, and then the price is going up and it comes down, and it's going up and it's coming down. So the prices are kind of narrowing down in a certain direction. The chart, price, time, candles going up, down, up, down, up, down. Yeah. Now if we draw two imaginary lines connecting the highs and the lower lows of this formation, you actually end up getting a triangle formation. Yeah, now these lines have to be drawn by you. They are not seen on the chart, you have to draw them. These are imaginary lines which you are plotting. So you take the highest points and draw a line, and then you take the lowest points and you draw a line, and somewhere down the line it is going to converge. So now what is happening in a triangle formation? What is happening is that this is where the bulls are, this is where the bears are, this is a huge buying pressure, and as the buying pressure goes on increasing, it is not a steady buying pressure, but bulls are getting more and more eager, buyers are getting more and more eager. So because they are getting more and more eager, they are increasing the price steadily. Yeah, they feel that they are not going to get the price at this level anymore, so they need to constantly increase the price. On the other hand, what is happening is, this is where the bears are, and bears are selling, and there is a lot of selling pressure, and while the bears are selling, they are reducing the price because they feel that they might not get the price at the same level, so they are getting more and more keen and more eager and more emotional, and the emotion would be fear, and hence they are lowering the price. So this side are the bulls, are the buyers, this side are the bears, are the sellers, and as the bulls and the bears are steadily increasing the price, you can actually see by drawing a line that there is a triangle formation which is taking place. Consider that you are drawing and seeing this to be the length of the triangle. So if you take the tip of this to the base of this, you would call it the length of the triangle, and let's call it as 3L. Yeah, which means this is the length, this is 2L, this is 3L, so 3L in total, L and 2L. And as you draw the length of the triangle as 3L, what happens is, or what is expected to happen is, that after 2L the prices are either expected to go up or the prices are expected to go down. Now why does this happen? Either the bulls have become very eager and they have become extremely aggressive and have absorbed all the selling pressure, and because they have absorbed all the selling pressure and there is a huge buying pressure, the price goes up. Or the bulls have exhausted their money, they don't want to buy anymore, and since they don't want to buy anymore, there is a huge selling pressure, and because of the huge selling pressure, the price actually goes down. So in a triangle formation, either the price goes up like a rocket or goes down like a stone, and the expected time frame for this is after 2L, after the length of 2L. Yeah. Now one more, let me put one more paraphrase on this. And if we draw this as the height of the triangle, this is the height of the triangle, how long are you expected to price go up or down? If it breaks up from here, which is called as a breakout, price can go up by the length of h to 1.5 h, which means if this is h, price can go up by h to 1.5 h, or it can go down by h to 1.5 h, which means, again, very quickly, let me explain to you. Price is going up, down, down, up, down. You draw two imaginary lines, and as these two imaginary lines conclude here, this is what we call as the length of the triangle. Bulls are getting aggressive and are buying higher and higher because they are getting greedy. Bears are also getting aggressive and they are selling and selling because of fear. Somewhere down the line, either the bulls win or the bears win, which means either the demand exceeds supply or supply exceeds demand. And when that does happen, if the demand exceeds supply, the supply gets exhausted and the price goes up like a rocket. But if the supply exceeds demand and the demand gets exhausted, price goes down like a stone. So for us to make a money out of this formation, what you need to do is, after 2L, you put a buy order or you put a sell order. This is called as a touch if buy, touch if sell orders. You put a buy order, and as the price breaks up, you buy the stock, price goes up and you make money, or you sell the stock, price goes down and you make money. Yeah, different type of triangle formations which are into play. Yeah, so there are about 3 different types. Yeah, in this, the price is going up, and this is the kind of formation which happens. There's a price going up, and this is the kind of formation happens, or the price is going up and then both these sides of the triangle are going with an equal force. So this would be called as a descending triangle because price is going up and the prices are descending here. It's a descending triangle. Yeah, this would be called as an ascending triangle. Yeah, the triangle is ascending. Here the prices are fixed, but the bulls are getting more and more aggressive. Here the bulls and the bears are equally aggressive, and since the bulls and the bears are equally aggressive, it's called as a symmetrical triangle. So let's further look into all these 3 types of triangles. What is happening in the descending triangle? In the descending triangle, the bulls have decided that they are only going to buy it at this point. They are not getting impulsive, they are not getting more aggressive, but the bears are getting very aggressive, and they are getting very aggressive and very impatient, which means they are ready to sell at a cheaper and cheaper price. And since they are ready to sell at a cheaper and cheaper price, there is a chances or a high chances that the price will break down and go down. On the other hand, let's look at an ascending triangle and what's happening in an ascending triangle. Here the bears are cool, calm and composed, but bulls are getting aggressive because they feel that the price of the stock is going to go up. So they increase the buying pressure, and as the time passes, they are increasing their bids, and as they are increasing their bids, the bears are cool, calm and composed, but the bulls are getting aggressive. And in this kind of formation, there are very high chances the prices may break on the upper side. Again, you can't be very sure whether the prices are going to break down or break up, But here the chances are high that the prices will break down. Here the chances are high that the prices will break up. But let's understand and see what happens on symmetrical triangle. In symmetrical triangle, what is happening is the bulls, which means the buyers, or the bears, which means the sellers, are exerting equal amount of force. Bulls are also getting aggressive and bears are also getting aggressive, and both of them are getting aggressive. Here there are equal amount of chances that the price may break up or break down, but because the trend has been prior up, there are much higher chances that the price will break up. But again, you can't be very sure about it, right? So here you are, different type of triangles. This is triangle formation. You can trade the triangle formations. You can make a lot of money out of it. Price is going up, descending triangle. Price is going up, ascending triangle. Price is going up, symmetrical triangle.